Money.
The federal funds rate and mortgage interest rates. How does the Fed funds rate, when they increase, affect mortgage interest rates and other things that affect your money? We're going to talk about that, yes. On Wednesday, the Feds did increase by 0.25%. So what does that mean for you? I'm just going to break down a few things that this can affect by the increase. Every month, all eyes turn to the Fed to search for any clues in language that's being used to try to determine when the rates will increase, which they have. It finally happened. Your life is likely to be affected in several ways, and I just wanted to share a few ways with you today. So your credit card bills could get more expensive. The vast majority of credit cards in the United States have variable interest rates. Generally, your interest rate is determined by the set rate that comes from your particular cardholder agreement. Now, you may not notice too much of an impact, especially if you carry relatively low credit card balances. However, if you have high credit card debt, say $10,000, and a small rate can be pretty noticeable. In this case, an extra 1% interest means an extra $100 a year. This would mean that out of your monthly payment, about $8,000 more would go towards interest, not paying down your balance. Now, in short term, a rate increase means it will either take you longer to pay off your credit cards by simply making the minimum payment, or your minimum payment amount may increase. Now, some of your investments could be affected as well. The interest rate changes can affect your investments in a variety of ways. For interest, banks with large lending portfolios can see profits rise with interest rates because spreads between the interest banks pay and the interest they charge tend to widen as the interest rates rise. Now, however, some investments can negatively be affected by rising interest rates. This is especially true when fixed income investments like bonds. Now, bond prices fluctuate based on the prevailing market interest rates and the coupon rate of the bond. For an example, let's consider that you buy a 30-year Treasury bond today for $1,000 and your bond has a coupon rate of 2.6%. The bond will pay out $26 per year for the next 30 years. Now, however, let's say that rates jump up 0.5% and the standard coupon rate for a 30-year Treasury rises to 3.1%. Because that yield for investors expect, you should have to sell your bonds at a discount in order to make them competitive with the market. Now, in order for your bond, which pays $26 per year, to yield at 3.1%, its value would drop about $840. This is simplified examples, and there's a few other factors that contribute to bond prices, plus the bond shorter maturities will affect less than longer ones. Just be aware on how rising interest rates can affect your fixed income investments. Now, last, of course, mortgage interest rates. This is my arena, what I do full time. Mortgage rates are dictated mostly by market and movements, but the Fed can have a huge influence on rates. Even though the federal funds rate is not tied directly to mortgage rates, it affects them indirectly because it impacts lenders' borrowing costs. So if it is more expensive for banks to borrow, they will pass the expense on to the customers. In the current environment, any changes will be direct, instant and negative impact on mortgage rates. So the Fed also uses monetary stimulus programs such as bond purchases to help keep mortgage rates where they want them. Now, when the bond fed mortgage bonds and U.S. Treasuries, it increases demand for these investments. Such purchases tend to keep mortgage rates down. In the other direction, the Fed can decrease demand by selling bonds, which could send mortgage rates up. So Fed's economic projections also influence mortgage rates as they affect investors' sentiments. A gloomy economic outlook usually means lower mortgage rates. Signs of a stronger economy often result in the higher mortgage rates. So takeaway, there will be some impact on your finances with the Fed's increasing. When it comes to mortgage rates, just watch the bond market. When the bond market's trading higher, that's good for interest rate. The bond market drops and loses in trading price, it'll be bad for interest rate. So it'll be interesting to see. Anticipation is we're not going to see drastic changes with the Fed and the Fed's fund rate, but they will steadily be increasing. So keep a watch out for that. Coming up next in the Money Hour, are you considering a possible career in real estate? What do you need to know? More from Windermere Services panels after this short break right here at 11:50 a.m. KKNW.